You're watching Beyond Markets. Welcome, I'm Esther Awuni. Many thanks for joining us. On today's show, we'll discuss the 5-year policy direction of Nigeria's Apex Bank. You can join today's conversation with the hashtag Beyond Markets, and you can follow my Twitter handle too at Esther O. Awuni. Now, while unveiling his policy direction for the next 5 years, the governor of Nigeria's central bank, Godwin Emefiele, says Apex Bank plans to keep its foreign exchange system, recapitalise banks, and boost credit to different sectors of the economy, among other initiatives. Bismarck Rewane, CEO of Financial Derivates, joins me for this discussion. Bismarck, always a pleasure to have you on the show. So, a very robust plan that the central bank governor rolled out yesterday for the next 5 years, but and some of them have elicited different mixed reactions. But for you, let's start with what your own key takeaways were from the meeting, and we'll take it from there.
I think it's a bold and prudent move, and he did the right thing in the sense that he says, in conjunction with the fiscal authorities, we would do the following. So, but almost everything that was rolled out are fiscal objectives. And fundamental rules in economics, you do not use monetary policy tools to fix fiscal problems. So one would assume that he's actually sitting in for the fiscal team. When the fiscal team comes in, then we'll go and actually implement the economic recovery and growth plan. But there were some distinct differences between what the economic recovery and growth plan, which has been adopted by the federal government of Nigeria and ends in 2021, and this wish list of objectives. So I think that is one of the big problems here.
So would there be a clash?
Well,
would you say to some extent quite a number of them complement what is already written by the fiscal authorities?
No, I think the fiscal authorities were very specific. You need 6% growth by 2021 to deal with full unemployment. When you now say that your growth target, right, is double digit, it means anywhere between 10% and 99%. You got to be specific. It can't be that vague, right? And you talk about bringing down inflation to single digit. Single digit means anywhere from 0.01 to 9.9, right? That's single digit. No, the range, the inflation target cannot be between 0 and 10. It has to be more specific, it has to be narrower. And that is how central banks set their targets. So it's an ambitious plan, or an ambitious blueprint. I don't want to call it a plan, because planning is the responsibility of the Federal Ministry of Planning and Budget. And we already have a plan, right? So this is a blueprint of how the central bank seeks to stabilize the economy in case there's overheating or there's underperformance. That is the role of central bank. To maintain price stability, maintain external balance between the external economy and the domestic economy, and actually to intervene where necessary in the intermediate aggregates of money supply and maintain stability in the banking system. I mean, that's what it is.
I mean, talking about interventions, quite a number of interventions that the CBN, talked about for its 5-year plan. I mean, some already ongoing. We've seen some in the past in critical sectors like agriculture. The Anchor Borrowers Program is one notable one, and he speaks about doing even more for key sectors, still agriculture, and he mentioned specific crops that he said, the bank would give a part of the 500 billion naira loan to support those sectors to reduce the importation of those particular crops. So I mean, the language here from the central bank governor is one of, at the heart of it all, we're trying to boost economic growth. We want to create more jobs, boost or reduce unemployment, grow GDP growth, boost key sectors at the end of the day. So I'm just wondering, I mean, the language is all about,
it's fiscal.
This is fiscal. The language is fiscal at the end of the day.
Yeah, there's fiscal responsibilities are very well defined. The fiscal arms of government are the Federal Ministry of Finance, the Federal Ministry of Budget and Planning, the Ministry of Trade, Investment and Industry, period. We also do have a Bank of Agriculture. So these interventions are to help and provide support for the areas. It's like having a lesson teacher if your child goes to school. The lesson teacher is not a substitute for your standard education. So the interventions were necessary at the time when the economy slipped into recession. So there was coordination between fiscal and monetary authorities to give the stimulant and to ensure that we don't go off the rails. But you cannot make intervention or emergency service a permanent feature. So what this tells me is that this economy is in dire need of structural change. If the structure does not change, the functions will not perform effectively. And there's a basic concept of structural functional dynamics as elucidated by Emil Durkheim in sociology. Once the structure does not change, the outcome of the functions are going to be suboptimal. So when I say structural change, you're talking about structure of the foreign exchange market, structure of the Nigerian money market, structure of the petroleum industry. Structural change will elicit optimizing the transient and transitional elements of economics. And that is what it is. You cannot use transient features to actually change the structure. You can't have a staircase in a bungalow. You can only have a staircase in a story building. So the structure, Nigeria is asking to have 3 floors in a bungalow. You can't.
Speaking about structure for a more monetary policy focus now, the exchange rate, the central bank governor has said that the managed float regime will continue. And for him and for the market, there's been stability, there's been supply. We've seen the foreign investors become less nervous. They can now repatriate their funds. So it's all worked out, and I suppose that's where the
I don't know that that is the case.
From.
Stability in economics, the word is equilibrium. If you have disequilibrium and you have stable disequilibrium, it's only a question of time before you will have distortion to resource allocation. So where is the price? Where is the equilibrium price? The equilibrium price is only one price, and that's where there's unification. When you have multiple rates, that plays to an inefficient structure. Is it getting better? Yes, it is getting better because the rates are converging, right? But there's still a wide band between 305, 326, 345, 358. The multiplicity of rates is inefficient.
Yeah, and some might argue that, yes, maybe not the most ideal or efficient manner, but, it's taking you maybe a longer distance, maybe like in a circle to get to that point. But you're still on a path that will get you there anyways. Maybe, might take longer.
Why walk if you can run? You see, you don't have time. You have to optimize the resources you have. And the numbers speak for themselves. There's optimization of resources. There's doing the right thing at the right time. And there's theory of comparative advantage, especially when you are now going into regional integration. Whether we like it or not, I think Nigeria is likely to sign the African Free Trade Agreement.
And speaking about, he did make a comment that Nigeria is committed to a free trade regime that is mutually beneficial. So that tells me that he is open, the central bank, but then again, it's not fiscal.
He's not the Minister of Trade. So,
yes, so that was where I thought, you're the central bank governor.
In law, there's what we call trespass, right? And you have to give it, and that's why I said in conjunction with the fiscal authorities, we want to see the following, right? So I think that is clear. But if you trade agreements or trade flows are supported by currency regimes, and if all your trading partners have a singular currency value, and you have multiplicity of values, what it does is to encourage ulterior activity of smuggling, both export and import smuggling. It undermines economic planning, it undermines growth targeting, it undermines a lot of things. So I'm not saying do it overnight, but you got to have a deadline by which this currency will have a unified rate, and then you intervene in it. Whenever there's a shortage, you sell into it, and if there's a surplus, you buy away from it. And so the central bank is just one participant in the market. Right now, what you have is a price discriminating monopoly, where you are selling the same product with the same value, at different values in different markets. And so it leads to financial osmosis, which is where there's a problem.
Now, for the interventions on the one hand, then there's also the banks, the issue of lending, getting that credit to small and medium enterprises who are the backbone of the economy. But the Apex Bank has said, okay, one of the ways we're going to do that is to empower the banks more, increase their capitalization. I know you have an interesting perspective on that. And for this, the central bank's rationale was, look, we need these banks to be able to take on bigger ticket deals, and we need these banks to lend more to the economy. I mean, in the last 5 years, what we've seen these banks do mostly is they have a small band of customers, clients that they lend money to, and more importantly, they play more at the fixed income market, at the securities market. So the central bank has not been able to, in the last 5 years, to get those banks to do that. I mean, the banks have their reasons, and they're quite legitimate reasons anyways. But I'm just thinking, for the next 5 years, how is this going to be different? What is the central bank? I mean, from what he said, it's the same. It was the same.
No, but
it was the same
is the problem of ineffective intermediation of funds between savers and people who want to use funds? Is it because of lack of capital? No. So if you increase the capitalization, yes, it will. In any case, all the banks have capital raising programs. Yes, it is true that you need buffers in case there's a shock that comes in, and you need to encourage banks to build those buffers. And one way of encouraging banks to build those buffers is to actually reduce the dividend payout, which the central bank has to approve.
Capital retention, yes.
Right. But let's look at it. In 2006, the banks were 75% of market capitalization. Today, they're 19% of market capitalization. All those who have invested in banks have actually got burnt, except you bought it way back in the private placement. So I think the banks need to actually, they were 108. We came all the way to 40 or something, now down to 23. You've just licensed some new banks, and now you're trying to increase the market capitalization. If anything, I think we require stability of policy, and you already have banks cannot do certain things if they don't reach a particular threshold of capital. But having said that, we look at what has happened in Tanzania and what has happened in Ghana. They've increased capital requirements. And when we did whatever it is in 2004, 25 billion was, I think, roughly $200 million. If you are to do it today, these banks need to raise 75 billion. One of the newspapers today said 250 billion naira. No, that's not going to fly. But I don't think it's something that we are thinking about increasing. When you want to increase market capitalization, you come and say, this is it, and this is the time frame. And then people would either merge or they will raise additional capital. But the stock prices have come down so sharply that it's only 19% of market cap. If you increase the supply of bank shares again into the market, you know what's going to happen to the price? They come down further.
Yes, but my question is, if the banks do recapitalize, we don't know what the figure is going to be. The central bank is going to have a meeting with the banks themselves. What difference? What is going to be that one key difference?
It won't reduce the risk aversion.
Would they take on bigger ticket deals, which is the central bank is hoping would happen?
What we want is a retail banking revolution. We have fintechs, retail banks, and everybody, right? Credit card companies, reaching out to the mom and pops, the widows and orphans out there. That's a target market. If those guys can have access to credit, if those guys can have access to banking services, which, well, by the way, it's one of the things, financial inclusion, then you would have achieved that level of intermediation. The big companies can take care of themselves. They do the disintermediation. Dangote has done 3 or 4 commercial programs run in the market. Nigerian Breweries is doing that. MTN is doing it. They can raise market debt any day. But the guys who don't have access to market debt are the young, budding, energetic, vibrant individuals and artisans, and so those are the people. And the banking system has to provide services to that, because they take deposit from them, but they don't lend to them.
Yes.
That's a big problem.
We're going to have to take a short break at this point. We'll come back and pick up from where we left off. Thank you for your time so far. I'll be speaking to Bismarck Rewane, CEO of Financial Derivatives. If you're just joining us, Bismarck Rewane, CEO of Financial Derivatives, is with me today, and we're discussing the 5-year policy direction of Nigeria's central bank. Bismarck, thank you for your time so far. Let's move this along. part of the robust plan, strategy of the central bank is to achieve $12 billion in non-oil exports by the year 2023. And of course, that takes us back to the conversation of intervention schemes, especially in the agri sector, providing more credit, much needed credit to the farmers. He talked about improved seedlings. He talked about boosting, certain crops, especially cash crops. But what is your take on this, boosting non-oil exports to the tune of this amount?
That's a great objective. And the honest truth is that the best way to boost your non-oil exports is to allow your currency regime become much more efficient. Because as you know, the Chinese and the Americans and Mexicans, the trade war is always complemented by currency, competitive devaluation of their currencies to make their exports cheaper. All right? So if you are going to achieve $12 billion of non-oil exports by 2023,
yeah,
then you better, in the year 2019, you better allow for a change in the structure of the foreign exchange market. And so that if you achieve a unification of rates and you allow yourself moving towards a convertible currency, it becomes easy. It's easy to, those two are complementary and aligned goals because your currency value makes your exports cheaper and more competitive and moves you away from the reliance on oil.
So you're saying that with this current structure of our FX, we may not be able to achieve this?
You could. No, I mean,
said that we would maintain the managed fleet system.
No, it's not a binary choice. It becomes easier for you to achieve that objective if you did this. It's like saying that, okay, the fact that there's no light doesn't mean I will fail my exam. But the fact that there's light means that I can read at night and I'm likely to get 3 A stars instead of 3 A's. You will still pass, but you would have done better if this was there. You will do better in your non-oil exports if your currency regime is efficient. So an efficient foreign exchange market leads to an effective non-oil export outcome.
Now, you also talked about, a particular instrument that would allow the processing of documents for exports to be easier this time. So, what are your thoughts on that?
I think that's wonderful. It's part of the ease of doing business.
The trade monitoring system, yes.
Trade and all of that. So, we had a visa upon arrival in Nigeria. Then all of a sudden, somebody stopped it, right? So people arrived, and so you have to go online and do something and all that. So, if I can get to Apapa port, then the one day becomes really efficient. But even if I got 1 day and the trucks get into Apapa in 2 weeks, it defeats the purpose.
Let's also quickly talk about. It's a long list. Let's look at the part about financial inclusion. Hoping to achieve 95% by the year 2024. Obviously, the banks will be involved.
That's possible. It's a major goal because what it does, financial inclusion of 95%, is accomplished by an efficient electronic payment system. So you don't have to go to the bank and all that. And when you do that, you increase the velocity of circulation, which is about 3 now. So if Nigeria can, 2024, go to a velocity of circulation of about 7, you see transaction flows are efficient, means that money gets back to you in time, and then you redeploy, and then increases output. So there's a strong correlation between high velocity of circulation of money and output growth. And output growth leads to increase in the standard of living of people, because what has happened over the past 5 years, Nigerians have gotten poorer in dollar terms every year, and now it's getting desperate.
Now, I want us to go back to the issue of lending by the banks, because it would appear that the plan of the CBN is, to me, twofold. One, getting the banks to lend more to the economy, to SMEs, and then, of course, ripple effects, job creation, and all of that. And then on the other hand, boosting, increasing the intervention schemes to key sectors so that they also gain traction, and then we can, boost non-oil exports, etc. But my problem is getting the banks to lend this side of the plan.
Okay.
Lending. Are you optimistic that what we didn't achieve in the last 5 years, we can do it this time?
There are many constraints to lending. One is liquidity, because if you take 22.5% of my money as CRR, right? So ab initio, I'm already at 78% of the money which I can now lend, and I have to make other provisions. 1. 2, I have to comply with IFRS 9 and all of that, and I have to make provisioning under expected credit losses. 3, is it price of money or risk aversion, because the chances and the probability that these companies are not going to be able to repay. So when you have complexities of this nature, when you have so many unknowns, the default mode is to just sit on your money and wait rather than give it out and lose it. So there has to be a much more fundamental discourse between the banking system, the regulators, and the market, because these guys are transmission agents between savers on one hand and borrowers on the other. And the transmission agents make their decision based on the signals they see and their perception, their fears and greed for risk. So all of these things are put together, makes you decide. How come credit to the public sector, to the government, has increased? Because people are buying T-bills. Because they've discounted the risk to a point. They've done the risk-reward trade-off. But if I have to go and make small SME loans and all that, there's a risk factor in it. And there's microfinance banks and all that, but it's not getting there. So we got to look at how an efficient system can be developed. We are getting there, but it's going slowly.
So it's possible.
It's possible, but impact is not
we can actually see a change this time.
Absolutely.
Getting the banks to lend
so
more.
There's moral suasion, but the important thing is that if we allow the currency to find its true value, and we can use the currency as a tool for managing liquidity in the banking system, then interest rates will come down significantly, and borrowing becomes affordable and feasible. At 28%, 29% credit, you are headed for a credit collapse. It's a bridge to nowhere.
And at the last MPC meeting, the Apex Bank governor did say that he was going to stop the unlimited access of banks to government securities. Do you think that is what we're seeing here? Is that going to also be a key factor in just
the only way to
gently persuading these banks into the
you
that
cannot,
direction of lending
again,
more?
That's controls which don't work. If you want the banks not to buy treasury bills, all you have to do is to reduce the treasury bill rates. They won't be attractive. They will now look for where they will get a better return, right? So if you are having
they're not the only ones buying these government securities.
No.
We have FP.
No, and that's what I'm saying. It's a dynamic equilibrium. If you have static disequilibrium, you're holding interest rates for international borrowers at a particular rate. Those same, you cannot stop them. The Nigerian banks will go there and buy that. And every time they buy that, they leave you out. And in spite of that, look at the amount of covered bonds. Look at the amount of overdraft of the federal government and the central bank. That is a major issue that needs to be dealt with, because that, in reality, is printing money. And that is inflationary. So if the Central Bank of Nigeria is funding the federal government through what you call elegant ways and means advances, then it is something that needs to be looked at if you are going to have dynamic monetary equilibrium.
Yeah, talking about equilibrium, we only have 3 minutes left now because we're still waiting for the cabinet, we're waiting for the fiscal direction. We already have monetary policy direction, at least we have one side. But in terms of synergy going forward, what are your expectations? How do you see this playing out? We've talked, you and I have talked in the past about the kind of economy we want to be. Do we want it to be private sector led? Do we want to be market driven? Those are the questions that we continue to ask. But for you, what are your expectations in terms of how this economy is going to move forward in the next 4 years?
It has to be an investment-led.
2.7% projection for this year alone. I don't know.
No, investment-led strategy in the sense that investment as a percentage of total GDP is only about 16%. In other words, we have $66 billion of the $426 billion. If we cannot get investments up to $120 billion within the next 2 years, then we're in difficulty, because that GDP is not going to go to $700 billion, which is what we require. How do we get investments to go from 66 to 120 to 140? We've got to do the right things, say the right things, and collaborate with the private sector and everything. In other words, you have domestic savings, you have diaspora remittances, you have foreign portfolio investors, which hot money, and then foreign direct investment. Those 4 components are responding to your signals. So the fiscal team will be in place. I think that they're going to make some structural changes, which is absolutely necessary. Without structural change, you're not going to get functional efficiency. I think there's no question about it. So this is the first good move. I think it has to be followed up with structural change.
Okay, we'll keep our fingers crossed. Thank you so much, Bismarck, for sharing your perspective on this. We appreciate your time on the show today. I've been speaking to Bismarck Rewane. He's the CEO of Financial Derivatives. That's it on Beyond Markets. Thank you so much for being a part of it. Remember that you can watch the show at 5 p.m. West African time daily and have access to all previous episodes of Beyond Markets on our website. That's cnbcafrica.com. You can also stay engaged with the hashtag Beyond Markets. And of course, you can send tweets to my Twitter handle too, at Esther O. Awuni. For myself and the team, it's bye for now.